So, hello and welcome to blockchain.com webinars. My name is Kieran MacDonald Hall and I'm a Director of Engineering here at blockchain.com. And today I'm joined by Alexei Zamyatin, who's a co founder and CEO of Interlay, which is a decentralized layer one network which connects cryptocurrencies to like Bitcoin with DeFi platforms like Polkadot and Ethereum. With around $8.5 billion of wrapped BTC used in DeFi, the Bitcoin DeFi market is huge. Bitcoin exists only on the Bitcoin blockchain, however, and moving it to other blockchains, a process known as wrapping and bridging, often relies on centralized solutions, forcing users to give up on one of Bitcoin's most important characteristics, its decentralization. In this session, we'll discuss Bitcoin's role in DeFi, the problems users currently face, and the proposed solutions. So, to kick things off, Alexei, could you give us an overview of the current state of Bitcoin in DeFi?
Hey everyone, and thanks for having me. Sure. Bitcoin and DeFi have had a very long-standing relationship, and that has been always going on off, right? As you could say, um, there is a lot of demand to use Bitcoin for more than just payments, and we've seen this as more and more people try to find new solutions, find new products by moving Bitcoin to other blockchains. Now, as you already mentioned, today 99.9% of this BTC that is being bridged onto Ethereum and other blockchains is actually bridged through centralized providers. And at the peak, we had around $8.5 billion worth of BTC in DeFi on Ethereum alone, which is a huge number, right? That's a very big market. A lot of people actually experimenting with Bitcoin in these decentralized products. Now, the issue here, of course, is that when we use centralized bridges, we kind of defeat the purpose of Bitcoin and DeFi, right? It's still better than using a centralized exchange where you have no idea what's going on in the background, potentially, right? As we've seen recently. Um, you still kind of see that assets are locked in the Bitcoin chain with a custodian, but these bridges might break. And we've seen recent examples with the Solana Bitcoin bridge just crashing and depegging and RMBTC shutting down on Ethereum in a very short period of time, which caught a lot of users off guard. Now, if we look at the overall ecosystem, right, you have Bitcoin itself with quite a few projects trying to build solution directly onto the Bitcoin blockchain, and we can talk about how this can work a bit later. And then you have side chains that are very close to BTC, maybe kind of try to even leverage Bitcoin security like RSK and Stacks. And then you have these other ecosystems where DeFi has really been flourishing and booming, like Ethereum, Avalanche, Cosmos, and Polkadot, and all of these other new DeFi chains, which have these growing and really active ecosystems where people go to really trade and experiment with new financial products. And of course, they really have high demand for Bitcoin as the most popular, the biggest asset in the cryptocurrency space. Um,
Yeah, that's super.
but as mentioned, unfortunately, most of these things are relying on centralized providers.
Yeah, I think that's really interesting. And 2022 certainly showed us the fragility of the centralized networks and also the huge number of hacks on these centralized bridges as well. It's definitely the most fragile part of the system. Um, yeah, that's really cool. So, I guess leading on from this, what do you think most people use BTC for in DeFi?
So we've done some research analysis and tracing what these different Bitcoin holder addresses do on Ethereum, Avalanche, and some other DeFi chains. And what we see is that the number one use case by far is borrowing against Bitcoin. So using BTC as a collateral. So people who use this strategy essentially have BTC holdings or believe that Bitcoin is going to increase in value over time. They're long BTC, but still want to gain exposure to these other newer ecosystems and try things, or essentially borrow capital, specifically USD stables against this. And if we look at, for example, Ethereum at its peak, Ethereum had 200,000 BTC bridged over. Now it is around 100K, so it really decreased over time. If we look at all chains, like apart from BTC, it actually even went as high as 400,000 Bitcoin across Ethereum, Binance Chain, and so on. And if we focus on Ethereum as like the largest ecosystem out there with the most interesting data, we see that The number one use case there, as mentioned, is lending, with Aave and Compound leading the way with 25% of the BTC in the system being deployed into these protocols, mainly used as collateral. Because if you look at the borrowing rates, most people don't borrow Bitcoin on Aave and Compound; they rather supply it and borrow other things. And if we take a closer look, what they really borrow is USDC and USDT. So people mainly borrow USD stables and then go do something with them. Number two, runner up is MakerDAO, which is a USD stablecoin, which is again very similar to lending, right? You're borrowing a USD stablecoin. In this case, you don't have a counterparty, but you're borrowing against the protocol, you're minting a new asset. And then you have, of course, Bitcoin on decentralized exchanges to a lesser extent. The most popular wrapped BTC asset so far is WBTC, which is a centralized wrapped Bitcoin asset where BitGo is the custodian. Now, this is not really usable by retail users. You need to go through KYC and so on, and you need to find a merchant that will do the minting process for you. And usually these merchants are big players, like they charge you more for the minting than they actually pay themselves. So most retail users who really want to have BTC and want to go into DeFi, but can't really go through this institutional process, they were pushed towards less secure solutions, namely REM-BTC, which is also centralized, was using a multisig. And essentially what happened is people would mint REM-BTC, which did not have many integrations, but the main one was this pair on curve from REM-BTC to WBTC. And there they would swap for WBTC and then use that in DeFi. So REM-BTC essentially became the main off and on ramp for WBTC from into Bitcoin. And you would see a lot of arbitrage going on in this curve pool, because obviously when it went out of balance, too many people going in or too many people going out, there was a profit opportunity for big traders. Fun fact, Alameda Research was one of the biggest minters of WBTC, minting 100K out of the 200K back then, and they acquired REN-BTC sometime along the way. So, of course, you can imagine that it was kind of still quite centralized, and there were a lot of big traders, big companies essentially arbitraging and making profits on these margins there.
Got it. That makes sense. Yeah. So yeah, this problem of essentially having a very small number of people controlling the bridges from the Bitcoin network to the other networks uh, is a massive kind of risk all in itself, as has been proven, I guess, by Alameda. And that kind of leads us on to the second part, which is like the solutions to this. You know, how do we build things that allow us to start having more faith in the ecosystem again? And I'm guessing, given that you're at Interlay, the founder and CEO of Interlay, um, the question really remains: how do you sort of build a decentralized BTC bridge to move Bitcoin to other chains without relying on these sort of highly concentrated and highly centralized solutions that exist today?
So it's possible to build decentralized bridges, but it's not simple. And the long answer is, um, let's start with decentralization itself. Decentralization means that we distribute trust across a big set of different players. Ideally, this set is open so anybody can join, and then you have a decentralized system. The thing is that most people don't care about decentralization until they do, and that's when it's too late, when your assets are lost because you were using a centralized bridge, for example. Um, so the question is, how do we build a decentralized bridge essentially? And this leads us back to Bitcoin, right? So Bitcoin only exists on the Bitcoin blockchain, as you already mentioned in the introduction. And to move it to other assets, to other chains, we need to create a representation of BTC on this other blockchain. These things are typically called wrapped assets. So you wrap Bitcoin in the standard, or like in this mantle, like of an ERC20 token on Ethereum. Wrapped asset is essentially a certificate. It's an IOU, if you want to use financial terms, and whoever owns this wrapped asset slash certificate has the claim on the specified amount of BTC on the Bitcoin blockchain. So this is very similar to how you would trade a gram of gold on the stock exchange, right? You would not go to the exchange with holding this gram of gold and try to give it to someone. You would go and put it in a vault, lock it away. You get a digital certificate, and that you can trade. You can trade pieces of it, and whoever has that digital certificate can go back to that vault and claim the gold, right? This is, of course, simplified, but that's how this physical redemption works today. And it works the same for Bitcoin and cryptocurrencies. So when we bridge BTC to another blockchain, what we do is we lock it on Bitcoin, so you cannot do anything else with it on the Bitcoin chain. We create this wrapped representation, the certificate that basically says, okay, this thing is now one Bitcoin. And then we can use it, right? It adheres to the standard. It's compatible with all these DeFi protocols on the target blockchain, let's say Ethereum. And then when you want to go back, you destroy or you lock this certificate in the smart contract. So you basically say, okay, I want to go back now. And then you should get your Bitcoin on the Bitcoin blockchain. Now, building bridges is quite difficult. And as we know, 99.9% of cross chain asset transfers today are centralized. And the reason why this is the case is, well, because it's very, very hard to build decentralized solutions, but there's high demand. So people, try to bring the best thing they can to the market. Now, fact number one in this is that building bridges always requires some trust, right? You have two different networks and something needs to, or someone needs to connect them. And unfortunately, this problem is as hard as some of the fundamental problems in computer science. You need someone or something that really does this, facilitates this connection. Now, the best thing we can do is use these blockchains themselves, use the security of these two networks and avoid intermediaries, right? That's the basically ultimate solution. So you would have two blockchains that have smart contracts, and this is a requirement for this type of solution, and they would basically be verifying each other. So let's say you have blockchain A and blockchain B, and blockchain A basically can look at blockchain B and verify the transactions that are happening there. So a smart contract on blockchain A would be a so-called light client for blockchain B, right? So it verifies transaction, keeps track of what's going on. And vice versa, blockchain B would also be reading the state and the updates of blockchain A. And this allows us to avoid intermediaries. And the only thing we need to make sure is that the messages, these updates of which transaction happened on which chain, need to be included. And the model here is that it's enough to have one honest online player, and any one of us could run this piece of software that keeps this information in sync. And that's a very robust solution. The problem is that light clients are very difficult to build. Bitcoin is still one of the only blockchains that has a very robust light client. Ethereum's proof of stake light client, in fact, was recently discovered to be not as secure as everybody had hoped, which basically results in the current state of affairs. You don't really have any bridges that work this way. The only ecosystems which have light client to light client bridges are Polkadot and Cosmos, and also only because they connect chains that are the same type, right? It's basically copies, or like they are homogeneous. So the chains have the same standards, they look very similar, and that's where they can talk to each other. But talking from Cosmos to Ethereum, or Polkadot to Ethereum, or Ethereum to other blockchains is still not possible using this decentralized solution, unfortunately, due to technical limitations. They will be solved in time, but right now we're still kind of facing this technical barrier. Bitcoin, however, does not have smart contracts if we go back to the Bitcoin ecosystem now. So on the Bitcoin side, we can't use this solution even if it were available today. So the question is, how do we solve this problem for Bitcoin? And the easiest way to explain is by starting with a centralized solution that is quite simple. So let's look at WBTC. WBTC is a centralized wrapped BTC asset, and how it works is that you have BitGo in the middle. BitGo holds Bitcoin in custody, and BitGo tells the smart contract on Ethereum to mint this wrapped BTC asset to your account once you've sent BTC to BitGo. Now, step one on making this decentralized is removing the centralized custodian. So instead of having only BitGo, on the Bitcoin side, we allow anyone to become part of this network, to become an operator, or we could call them vaults if we use Interlay as an example. And each of these vault operators can now secure Bitcoin of users. And by allowing anybody to join, you make this a decentralized network. There is no longer a single point of failure. Now, step two is to realize that this itself actually is not enough. In fact, if we leave it as this, a decentralized network of anonymous people without any incentives, we've made it worse. Because obviously, if you send Bitcoin to a random person on the internet, why would they give it back? It's actually even worse. Like BitGo at least is a big public company, so you can try to at least sue them if they lose your BTC. So the third step is to introduce incentives, game theory, and that's essentially what makes Bitcoin work today. Like the entire cryptocurrency industry works on the basis of incentivizing correct behavior and punishing wrong behavior. So what we do is we take this decentralized group of operators and we require them to deposit collateral onto the smart contract on, let's say, the target blockchain, on the Interlay chain, for example. So all these vault operators lock up assets of different types in USD stables and other L1 tokens, but these have to be other assets than Bitcoin, obviously. And these assets are pooled and they serve as insurance. They serve as insurance against operator misbehavior. If an operator misbehaves, their insurance collateral is liquidated and given to the user as reimbursement. Now, sounds great. The last remaining puzzle piece is how do we make sure that we know whether things have gone wrong or not? How do we detect misbehavior? Right? We have Bitcoin, we have the Interlay chain, we have this network of operators, they're collateralized. But right now, the missing piece is getting this information from Bitcoin to Interlay. How do we find out that Bitcoin transactions have or have not been made? And this is where we add cryptographic proofs, right? Following the principle of don't trust, verify, we require operators to cryptographically prove that they have indeed made the correct Bitcoin transaction. So, specifically, that an operator has returned Bitcoin to a user that wants to go back from Interlay to Bitcoin. And we use this, what we do use here is, again, this light client. So, it's the same thing that you have on your phone when you have a mobile wallet. It allows the system on Interlay to verify that certain Bitcoin transactions have happened in a cryptographic manner. This means that an operator cannot lie to the Interlay chain, right? The Interlay chain can verify cryptographically that yes, this transaction has actually happened. And if operators don't submit this proof, then they're liquidated. And for you as a user, this means that you always know that you can either get back to Bitcoin and receive your BTC, or in the worst case scenario, you'll be reimbursed in this basket of collateral assets. So you'll receive capital in a different asset, which you can then go and sell for BTC and recover your Bitcoin this way. And this is it. That's it. That's a decentralized bridge.
That's
Now,
really cool. That
there's
throws up a ton of questions as well. So, like, I guess my first, well, my first question that pops to mind is, how do you so you're talking about this cryptographic proof, and that's the bit that I guess I don't fully understand. How do you cryptographically prove that you either received or sent Bitcoin to either mint or redeem?
So this cryptographic proof, I mean, cryptographic proof sounds very fancy, right? But essentially what it is, it uses the same concepts that your Bitcoin mobile client uses. So a light client stores all Bitcoin block headers, right? It does not download all transactions, however. So if you recall, the Bitcoin full nodes store everything, every block header, which is basically some metadata that provides us information about the current block, and then the transactions. Now, a light client like we use and like mobile wallets use does not store all transactions. It only stores this block header information, and the block header tells you the block hash, and it provides some information, including the Merkle root hash. And the Merkle root hash is basically what allows us to verify transactions. So in Bitcoin and in most other blockchains, transactions are stored and aligned in a so-called Merkle tree. So imagine it's just a tree where each leaf is a transaction hash. And if I store the roots, I can easily then verify if given this path along the tree to the actual transaction hash, whether this transaction is actually in this block. So when I want to prove to the light client that I have actually included a Bitcoin transaction in, let's say, block 5,000, I will submit a proof that consists of a set of different hashes. So if we start right here, I'm trying to visualize a tree, right? But
Yes,
essentially, you will provide a path along the way to the top of this tree of missing hashes to recreate essentially this path kind of from your transaction to this piece of information called the Merkle tree root that is always included in a block header.
got you.
And that's basically how 99% of light clients or like this principle applies to most blockchains in the space.
So that's really interesting. So then my next question is probably just a rehash of the explanation you've already given. Is what is it that's actually verifying that? Where's the actual verification of this happening? So, is it happening on the mobile device, and then how do you then sort of alert the system, I guess, that someone's uh, committed foul play and should be slashed? Where does that part play?
So the verification actually happens on the target blockchain as part of a smart contract, and the smart contract is enforced by the consensus of the target chain. So you can assume, so similar to how you have like hash logs and like scripts on Bitcoin that are enforced by all Bitcoin miners, and you can't try to defraud anyone because the all nodes would say no, this is wrong. Same concept there. You have the smart contract, and that smart contract has this Bitcoin verification logic encoded. So every miner or staker on the target blockchain executes this smart contract and hence confirms that yes, this verification is correct.
I see.
Now, how do you find out if something went wrong? There's generally two approaches in the entire crypto ecosystem towards these proofs of misbehavior or good behavior. Either you assume, okay, unless you prove that you're honest, we assume that you're guilty. And that's what Interlay uses. So in Interlay, the vaults have to prove to the smart contract that they made the Bitcoin transaction. If they fail to do so because they misbehaved or they crashed or for whatever reason they forgot, we will assume that they're dishonest, and then they'll be liquidated automatically by the smart contract. The other approach that is used in so-called optimistic designs is where you rely on fraud proofs. So in that we don't use that because it's a bit risky. But what you could do also is you could assume like, okay, everything is fine until somebody raises a red flag and says, hey, look, somebody misbehaved. Here's a proof. The problem with this optimistic approach is you never know, right? If somebody is paying attention, you have to introduce delays, and you don't know how long this delay should be. Whereas in this pessimistic approach, I would say that we use, once the transaction has sufficient confirmations on Bitcoin, and the vault submits the proof, everything is fine. And then the responsibility is not on the protocol to check whether the vault behaved correctly or not, but it's on the vault, and the vault must prove that it behaved honestly. So the incentive is kind of aligned with the operator, right? If the operator misbehaves, well, then they won't try to prove honesty.
Super interesting. Very, very interesting. Definitely could ask tons more questions. Um, but I guess we should sort of maybe change tack a little bit and just maybe look at what the road ahead looks like. So, yeah, where do you think we're heading, and what does it look like for Bitcoin within DeFi going forwards?
So I think there's kind of two ways to look at this. You have Bitcoin, DeFi on other blockchains, which is what we talked about right now. And then you have quite a few startups trying to build DeFi tooling directly into the Bitcoin blockchain. And I think, like, we know that Bitcoin on DeFi on other blockchains is possible. The challenge is, decentralized bridging. But then I think you can actually build DeFi tools directly onto the Bitcoin chain, but it will be limited. And the reason is that DeFi is basically a fancy term for simple or complex forms of trading and lending. And this requires other assets. Like, what are you going to trade Bitcoin against if you have no other ways to represent assets? And we had methods like colored coins and so on that were used a few years ago, but they never really gained traction because it's not really easy to use, and smart contracts are just so much easier. But that's why USDT moved from Bitcoin to Ethereum essentially. But there are new developments like Taro on Lightning, and now we have Ordinals, which also uses new techniques of essentially encoding some NFT non-fungible data into Bitcoin. So perhaps in a couple of years, we will have tooling that will allow us to represent some kind of trading on BTC, because atomic swapping one asset for the other, like one orange Bitcoin against a blue Bitcoin, that is possible. More complex things like leverage, derivatives, perpetuals, options, that becomes more difficult.
Got you. So essentially,
Yeah.
the lack of other tokens, for want of a better word, and the actual lack of smart contract capabilities as well, it really holds it back. Yeah, nice. So then I guess the question that follows on there is that really it sounds like the solutions aren't really on the Bitcoin network, at least not for now. So how do we move more bitcoins to, I guess, Ethereum, um, in order to get more into the DeFi game?
So I think the way to achieve more BTC in DeFi is to essentially actually hiding this bridging. People should not care whether they're going to Ethereum or Intel and Polkadot or Cosmos or Solana. Of course, you need to educate people. Look, you're going to another blockchain, and you like here's the risks. But if I'm comfortable with the risk of another blockchain of a smart contract chain, I should not worry about the complexities of bridging. That's one thing. It needs to be very simple. You deposit, you do something, you withdraw, with a difference that you can actually always see that your assets are there, they're insured, you can see how many nodes there are, how many operators are securing the system, it's audited, it's open source, there's a big community, a lot of eyes that can actually check if something goes wrong. And the other aspect is focusing on secure solutions. Like I think over the past few years or decade, we've been often trading off, a quick push to market for and basically using centralized solutions and picking this over a long-term robust decentralized solution. And FTX and a few other like exchanges, actually not name right. We've seen quite a few crash, and also a lot of bridges crash. The damage this does to the trust of people, it will take years to rebuild this. And I think it's really time that we learn from our mistakes and be very honest about the designs. And the last bit is again like education. I think educating the Bitcoin community that look, Bitcoin is good for this set of use cases, and we have a UX problem for DeFi. But look, if you want to, you can use DeFi on other chains, and here are the risks. And here are the centralized solutions, here are decentralized solutions. They have different risk profiles, and this is what you can do. And it's okay for you to use your Bitcoin, and you should be able to use your BTC for whatever you want. I think that's the key, right? I think discarding everything else that happens outside of the Bitcoin world as bad is not going to get us far. I mean, the world needs Bitcoin, and Bitcoin does need to adapt and evolve and innovate over time to really survive and remain this number one corner block of this entire cryptocurrency industry.
Thanks for that. I guess, I mean, is this also, so you're thinking that this is actually something that's almost necessary for Bitcoin to remain relevant within the sort of crypto space as well?
I believe so, yes. Otherwise, if I cannot, I mean, it's a controversy, right? Bitcoin has hundreds of millions of users. It's the most active ecosystem in terms of active wallets. But all the innovation happens on other chains. And it's a controversy, right? I cannot do anything with Bitcoin except from transfers without going to a centralized provider. And Bitcoin is actually what started this entire vision. So I think really the key to global adoption is to take the adoption that Bitcoin is driving and combine it with all these new tools and this innovation that we've been developing over the past decade on other ecosystems.
That's super interesting. And I guess there's a sort of inverse question to that, which is that, I mean, how important is Bitcoin itself to these other chains? Like, without that extra influx of collateral, I guess, or cash, Bitcoin as cash moving into these other systems, how well funded would they be?
I think now Bitcoin is really, if you look at the entire cryptocurrency industry, apart from USD stablecoins, Bitcoin is the only thing that can actually say it's a currency, and that it's a method for people to long-term hedge, like invest their savings and actually be sure that that it won't break or change. I mean, I've been talking to a lot of people, like funds users, and the number one thing I always get, whether the people are long BTC or not, is why they like Bitcoin is because it's robust and it's predictable. They know how it works. It's not changing so quickly. And as much as I, who try to innovate a lot on BTC, I don't like admitting it, but the ossification and the stability is one of the biggest selling points. And if you look at the global scale, the amount of decentralization and the distribution across these different communities that Bitcoin has achieved, nobody else has, no other asset has managed to do that. So if you look at other ecosystems, they have like, where does the value come from? It's either USD, which is always tying us back to this old traditional USD-based system, which is a risk, right? As we just have seen now with the SEC cracking down on stablecoins. Um, and then you have Bitcoin, which is the alternative. And that's it, right? There's either you go for USD stables or you go for BTC. And then, of course, we can recreate decentralized stablecoins, but they'll be pegged to the price of the dollar. And that's still kind of in kind of that's a middle ground, I guess. So if we're very honest, we don't have that many options. You need some asset that people trust, and Bitcoin is this asset.
Interesting. Wow, cool. That's really opened my eyes to quite a few things, actually. I love it. Um, so, yeah, I guess on to sort of my final kind of topic. And sort of we've kind of touched on this anyway throughout the conversation, but is it possible for self-custody BTC in DeFi? So for me to actually own my BTC in my wallet in DeFi.
I think so. That may be the holy grail, right? If that would be possible, that's the billion or trillion dollar question. I mean, that would be the ultimate feature. You have your Bitcoin, you can be sure that nobody can steal them, but you can still use it in some form. The question is it a contradiction by itself? And I personally think that it will be possible, but with limitations, right? Wrapped assets mean that they're very flexible, they're fungible, you can move them around, but they're always custodial, right? Wrapping means, at least in the bridging space, you custody, whether it's with one person, one entity, or decentralized and insured. There's always risk in some form, right? In the case of Interlay, your risk is okay. You might get other assets, and you have to go and come online and bridge back and trade for BTC, and you might not get the same price and so on. But there's always a risk, and the problem why self-custodied Bitcoin DeFi is so hard is, well, self-custody means that Bitcoin becomes non-fungible, right? They're in my wallet. If my Bitcoin is in my wallet and I mint, uh, let's say Alexei BTC, and I trade it to you on Ethereum, how will you ever be able to redeem it if they're in my wallet? Like, you have to trust me, right, to on the Bitcoin blockchain make the transfer as well. And we've designed solutions that go in that direction. We released a paper last year in May, which kind of takes a step towards using essentially roll-ups or commit chains on Bitcoin. But still, this fungibility issue is a big problem. But with the rise of NFTs, and now we see ordinals and we see a lot of NFT lending markets on Ethereum where you can borrow against your non fungible token, and the support for these NFTs suddenly makes this again very interesting. And I do think that there might be a solution. In fact, we've been working on different approaches for the past 3 years. And with this rise of these non fungible tokens and marketplaces for them, I do believe that self-custody BTC DeFi will be possible in some form.
I'm really looking forward to the future. Seems like a it seems like such a wide open space. Actually, definitely probably the least explored space so far. Um, well, thank you for tuning in today, and thank you, Alexi, for giving me such a detailed and uh, incredibly interesting uh, explanation of Bitcoin's uh, participation in the DeFi world and how we should be enabling it, as well as um, some very topical conversations around centralization and decentralization in bridges and exchanges. Um, I actually had one more question, which was how do you incentivize? So, just talking about Interlay's solution itself, what's the incentivization to provide a vault? Because I can see I can see how you can get into trouble if you provide a vault by being slashed. What's the benefits of a vault owner?
So that's a very, very good question, right? So incentive-based systems only work if you've incentive not only to, not misbehave, but to actually still participate honestly. So in Interlay vault operators, they take a cut of the BTC volume that goes through the bridge, right? So they take a fee from the Bitcoin that moved through Interlay when they go in, when they go out. And essentially, because Intel is not only a bridge by now, right, where there's an entire DeFi layer that's being built on top, and you can actually test it in the test network where you can trade, borrow, and do all sorts of financial things with BTC. And parts of these fees go back essentially to these infrastructure providers. You can think of it, it's not exactly as like Bitcoin miners, right? But it's similar. You have these, the vaults are the heart of the Interlay system, and a lot of the value that accrues from trading, borrowing, the volumes that happen there, and also the volumes that that basically go out of Interlay to other chains, there's fees taken from those, and these fees get routed back to these vault operators. So essentially, vault operators earn on the BTC that is bridged in and out. So it's like providing a service, and then you take a cut for the risk and the cost you have.
I see. And has there been any kind of movements in terms of, um, similar to how Lido works with staking, where you have people that sort of group together to create larger vaults and collect collateral from multiple people in order to sort of provide a vault infrastructure?
That's so right now. How the Interlink system sees vaults is there's one Bitcoin public key, and we derive addresses directly on chain. And we don't really care if it's one person, multiple people. We support multisigs and so on. But no one has built multisigs yet. But there's small DAOs, like DeFi DAOs, that actually jointly run vaults. Right now, it's more of like internal trust bases. But we're working actually on expanding to really multisig or like threshold and MP, or probably threshold signature support, to essentially allow bigger groups to join forces and to run vaults together. And in fact, then even separate this responsibility from running tech to providing capital. So similar to how people stake, right? Most of us don't run validators, right? And this is the same model that's currently being built on Interlay. So we started with a very tech driven approach. So you have to run your vault and really know what's going on. Now that this has been running for a year now on mainnet with real money, we're at the stage where, okay, this is stable. Now we're kind of decoupling this responsibility. So you'll have tech operators and you'll have delegators that can nominate and delegate collateral as a stake. And of course, you pick your operator. If you see someone that has been operating a vault for months and years without issues and so on, and they also have part like their own money in the game, then you might be okay to delegate to them. But yes, then you kind of enter this realm of the same trust model as you have in proof of stake, where you delegate money to somebody else, and if they mess up, you're kind of in for the slashing too.
Got you.
Um,
Very cool. Very, very cool. I can't wait to see more. I can't wait to see more. I think probably we've spoken for a reasonable amount of time now. It's probably good to draw this to an end. But thank you so much. I've really enjoyed this conversation, and if you enjoyed this discussion, then please remember to like and subscribe. And learn more about Interlay, please visit interlay.io or check out at Interlay HQ on Twitter. Um, and yeah, thank you for all your time. It's been very eye opening.
Thanks for having me.